Welcome everybody. This is the Saturday morning Viper Trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you're in the right place. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, well, the topic today was going to be risk management and trading trend changes part 2. But we've decided on the fly here to sort of mix it up a little bit and go with this notion of looking into trading different instruments. Let me get over to screen 1, excuse me, where we can get started on, and this is actually kind of the tail end of what we were doing in the last webinar on Thursday evening, which was the dollar index and 6E. By the way, can everybody see this chart? See my cursor? Two charts here. On the left is 6E, cursor moving. On the right, dollar index, cursor moving. Everybody see? Make sure we're all on the same page here. Okay, good. All right, let's go ahead and get started. So what we're doing here is we're kind of getting a little bit away from what we have in the room and exploring other instruments using the Viper trading setups for trading. And let me start off by saying this. Here is a brief list of instruments that I have on my. By the way, everybody knows how to add instruments into your list, right? Anybody not know how to do that? Your instrument list, where you can expand your list beyond excuse me, crude oil and the equities. Anybody not know how to do that? I can quickly show that if you need to. You know what, let me just go ahead and do that real quick. All right, just take 2 seconds here. Instrument manager, so you go to Control Center, Instrument Manager. Now inside of here is 179 instruments. You don't have to pay extra for any of this, Mindy. Once you have like a Continuum or CQG, any of your data feeds that come from the CME group pretty much have all these instruments in them already. Now the ones that I like to track and that you get HPTs on are the currencies. You can see them on the left here. This is recorded, by the way. It'll be on the web in case you have to leave, or I see people coming in, or you're trying to remember what to do with this. The ones I track are on the left here. The currencies are the 6A through 6S, the CAC 40, which is kind of like their Dow over there. Crude oil, you can see the dollar index. The DAX is like the German Dow, basically. This is the Bunds, FGBL. Silver, nat gas, palladium, and then this is the commodity complex down here. And what you do is you just simply, if you want to add an instrument, you scroll down, you select the instrument. Here, let's just do a hypothetical one. I don't see anything that's not in the list here. Let me pick one that's not in the list, ZR. Just push it over there, and now it's on your list. And what this allows you to do once it's on your list is to, it's on your drop down immediately, so you can load it into your charts right here, like this. Just go and you quickly pick out whatever you want to trade. Now I'm going to start off here with, I'd be careful with the DAX. There are some markets that you probably might not want to really trade. Like the DAX is a good example. It's wicked fast. I mean, if you think crude oil's fast, the DAX is like 2-3 times faster. Now 6E, if you trade these two instruments, you're going to notice that they are mirror images of each other. And there is a very big difference in risk. So I'm going to take a second before we get into the actual trade setups on the dollar index and 6E to talk about risk. When we say the word risk management, what are we talking about? What do we mean by that? Everybody throws those terms around pretty frequently. Risk management. What does that really mean? Risk management. When we say the word risk, what are we talking about? What does that word mean to you? The word risk management. And this is something that isn't really talked about much in trading. Any kind of seminars you might go to, or people out in the industry who talk about trading, whether it be stocks or Forex or futures or even options. A lot of people don't talk about the risk side of the business. But what does that mean? How much you can lose. Good. By the way, a couple people just coming in here. Hey, Adam. We're just getting started. BJ, welcome. There you go. Day losses per trade versus the percent in your account. How much you're willing to lose in a day. So let me ask that question. And it's a very important one that does, like I said, does not get talked about very much. How much are you willing to lose each day? I know how much I'm willing to lose. I have the number right on the top of my head. It's one of the most important numbers that I have in terms of trading. When I go into each day of trading, I know exactly how much I'm willing to lose. How much? Do you know? Everybody in here this morning, do you know how much you're willing to lose when you start trading a live market with your real capital? I see some numbers coming in. 2%, 3%, $500, $300. Okay, tell you what we're going to do. Let's do this real quick. And this was an important part of what I wanted to show and teach here today. I'm going to put this right up in here. 2%, 2.5%. I see some good numbers. 250, and I'm done. Okay. All right. Well, let's do this. Here's what we're going to do. And for you veterans who have been in here before, many times you've heard me really underscore this issue. But I'm going to do it very quickly right now because this is very, very important for your live trading accounts. And I'm going to put it right on this chart right here for you, okay, so that you remember it. So what you're going to do is you're going to take your the value of your trading account times 3 to 3.5%. Okay, and that is going to equal your max loss for the day. Okay, so whatever that number is, let's just take a hypothetical round number so we can do some very quick calculations. So if you had an account that was worth, say, $10,000, nominal amount of a sort of a mid-sized trading account, how much could you lose in a day? If you had $10,000 in your account, what is the max stop-out loss for your trading day? You can do the calculations. What would it be? So let's put this in here real quick. 10K account would equal how much? 3 to 350, yes? Yeah, about $300 to $350 roughly, plus or minus, depending on how much is actually in there. All right, so let's do some calculations. Let's say that how many stop losses can you take back to back if your average stop level, so I'm talking about your initial stop when you go into a trade, is 10 to 12 ticks. Well, in order to calculate that, you're going to need to know the size of the instrument tick-wise that you're trading, yes? So in other words, so if you're trading, let's do some quick math here and put this in here, and I'm gonna cover this fairly quickly and get out of it and get back to trading, because this is just numbers that you should all have in your, you should know them off the top of your head. You don't have to sit and do a bunch of calculations to figure this all out. So let's just say this. All right, so if you're trading a $5 instrument, like say NASDAQ or YM or the dollar index, so at $5 a tick, and you had 10 tick stops, 12 tick stops, let's say, how many losses can you have in a day? So each loss would be about $50, $60, right? Yeah, 5 or 6 consecutive losses. With no winners in between before you're stopped out for the day. Now with a 10 tick instrument, like the Russell, crude oil, etc., $10 per tick, which is twice the risk with 12 tick stops. How many stop outs can you have there? That's $60 a loss. Or no, I'm sorry, $120 a loss. You're looking at probably 2 to 3 losses before you're done. That's not very many, is it? Now this would be full stop out losses without any winners in between. Full stop out losses without any winners. So I think doing the math here, you can figure this out pretty quickly, and you can sort of assess your risk management approach based on the value of your. It's all driven by the amount of capital in your trading account. So for instance, if you had 20 or 50,000, these numbers would change, right? Be 2 or 3 times this. If you have a more modest trading account, like 5,000 or less, then that really dramatically changes this picture, doesn't it? Let's say you had 5,000. That cuts all this in half. If you had a $5,000 trading account or less, should you be trading a $10 instrument? Given the math that we have here. Well, a $5,000 account, you can only afford maybe a $150 loss to 200 tops. Should you trade a $10 a tick instrument? Should you trade crude oil if you have a $5,000 account? Now, let me just put that straight up. Any $10 tick instrument, Russell, gold, should you be trading those instruments at $10 a tick with a, if you say, let's say under 10, let's say you have 6 or 8,000. No, you shouldn't. That's the answer. You shouldn't. They're too risky for you. The tick value is too high, so that when you take full stop outs, that you can only afford maybe one of those, and there's not sufficient cushion for you to make mistakes throughout the course of the trading day. We all make mistakes. Every business has losses. Trading is a business. You're going to have gains and you're going to have losses just like any other business. You got to have a cushion to handle the losses. If you don't have enough cushion in there, what's going to happen is you're going to start to draw down your trading account. And if you do that in enough consecutive days in a short order, within a few weeks or a month or a couple of months, you can draw all the capital down out of your account to where you can't trade anymore. You're going to blow up accounts. The reason I know this and the reason I follow this is because I've blown up a lot of accounts over the years. When I got started, I blew up a lot of accounts. A lot of traders do. It's what happens. So we don't want you to do that. You don't have to go through that experience. And the way you do it is you have to apply discipline to your trading methodology to have proper risk management. And this is how you do it. Now you can listen. You can shine this on. You can say, "Oh yeah, I see these numbers, Charles. Yeah, whatever. Okay. Yeah, I like to trade gold. I love crude. I know I can make money. I'm going to knock it out of the park. I can make a few $1,000s tomorrow, no problem." And then you go in and you take hit after hit after hit, and instead of making money, your account's going down. You can't do that. You're not going to survive in the game to make it. Okay, so you got to have proper risk management. Now, in terms of profit goals, let's talk about the plus side of the business here. What should our profit goals be? You hear this in the room all the time. What should the profit goals be? You hear, "Oh, I hit my goal." You hear that in the room all the time, right? "I hit twice my goal today. I'm so happy. I'm not trading anymore. I'm going into sim. I hit 3 times my goal." Yeah, it should be 2x of your risk cap, 2x of the loss number. So in this case, you're looking at the hypothetical $10,000 level, you're looking at $600 to $700 for your goal. 2x. So that's it. It's not really complicated. Those are the numbers right there. Oops, I wanted to do this differently. Yeah, that's it. Your profit goal is twice your thing. So when you hit your profit goal, why do we stop trading when we hit our profit goal? Anybody? Well, Charles, I'm on a roll. I'm just in sync with the market. I see these trades. I'm nailing them. I am cleaning up today. Yeah, okay, I'm up 550. I know. Okay, I did good. I nailed a couple of good ones. I'm up 550. I think I should keep going. I see more trade setups, and I could double my goal. That's what I'm going to do today. I'm going to triple my goal. I'm going for it. I'm swinging for the fences. I know I'm going to nail the next one. You're not following your plan. That's right, Tom. You can give it all back in the afternoon. Exactly. How many of us have done that? You make it good. You make good money in the morning. You keep trading. You get into the afternoon, late morning, it starts chopping around a little bit. You take a loss. Oh, ouch. You know what? I'm going to shrug that off. I'm going to go back in. Right? I'm going to go back in. I know I can. Boom, you get another pop. Half your gains are gone. How many of you have done that? The human capital takes its toll. That's right, Carl. Yeah, it starts to affect your confidence then, yes? You wind up giving it all back, Lauren, and then some. How many days have you gone in there? You make some good morning. Let's just say a modest amount. You make a couple $100, couple $300 early in the morning. You go back in, you get a couple pops, you give it back. You're upset with yourself. Then you keep going because you want revenge, right? You want revenge. Now you're revenge trading. You're angry about it, and then you go home with a loss for the day. Doug says, "Stop talking about me." Listen, 21 years of trading, I can tell you this. These simple numbers that I'm showing you right here are going to be the key to your long-term success. If you can stick to these numbers, and it's not, like I said, not very complicated. It's not rocket science. It's not a very tough thing to do. The tougher thing to do is apply the discipline and the numbers to yourself and your trading and follow them. It's easy to get in there and you're just really nailing it one day. Hold on one second. Get these big mood swings. You get popped early and you get pop, and now you want to just, I'm going to make this back. Next thing you know, you take a $200 loss and you turn it into a $500 loss. Right? If I'm speaking about you and your trading habits, then really starting Monday morning or whenever you start trading, This, you have to please, please, please apply this discipline to your account. Aside from seeing the trades themselves, this is one of the most important principles to apply for your long-term success in trading. All right, good. Any questions on this? Risk management, proper risk management. All right, well, let's take the same principle and come over here and apply it to these charts. And I'm going to show them right now. Stand by. Back to these two. Okay, we have 6E and we have the dollar index. Now, from a risk management point of view, 6E is $12.50 a tick over here. Excuse me, and dollar is $5 a tick. Which one of these two instruments should you be trading? You being everybody in here this morning. $12.50 a tick, 6E, $5 a tick, dollar index. Think of your numbers. Think of your max loss and your trading account size and your profit goals for the day. In terms of pure tick value and the amount of target and stop loss for the day, should you be trading 6E, $12.50 a tick, or dollar index, $5 a tick? And some of you may be able to, with somewhat larger accounts, could you trade both? How many of you would trade both? $12.50 6E, $5 dollar index. I see a lot of dollar indexes, I see a couple of 6Es, and I see a couple of boths. So anyway, the takeaway for all this is your account size, your risk management numbers drive the logic behind what instruments you're going to trade and the tick value thereof of those instruments. Now let's look at the trade setups here. We know that the dollar index is a mirror image of 6E. So it's very good if you're only going to trade one or the other or both to have those two charts right next to each other. Now if you notice here, and we noticed this at the end of the tail end of the Thursday night webinar, is that they, aside from being mirror images, that they have a difference in the smoothness of the volatility. Notice how 6E tends to be a little more, how would you say, spiky. And what I'm talking about is in particular areas like this right here. Seeing the retracements, how they go slightly above the midband and how it retraces, and how when it spikes up sometimes it can be a tad bit spiky. Whereas those same retracements on the dollar index tend to be a little bit smoother in the way that it comes to the midband and holds it for your bounces to get long. So when we say things like instrument selection is also very critical and key to your success, this is precisely what we're talking about. In other words, each instrument has its own personality. Some of them tend to be a little more spiky in their movements. They're a little more sort of jagged when they pull back. How they pull back is they go, if you like midband trades, they can spike up a little bit above them, right? It can be a little more choppy when they move. Whereas other instruments, and this isn't good or bad, this is just the way it is, okay? This is just the way these instruments trade, okay? Over here you can see the dollar index tends to be a little smoother in the way that it trades. When it pulls back, it's not so dramatic and spiky. So this is also critical and key to your success. If you are a trader who doesn't mind to have a spiky instrument that is a little bit more sort of radical in the way it moves, and you like that kind of volatility, well then, aside from the tick value, go ahead, step in and take those trades. If that's your trading style and personality, then trade those instruments, because you'll get used to that kind of movement and you can take advantage of it and make some money on it, right? Now on the other hand, if you're a trader who doesn't really like that kind of fast spiky movement, you need something that kind of a little slower and a little more methodical in the way it moves, well then you got to find instruments like this, where when it pulls back you can have some confidence, which is key, right? The confidence that it's going to hold certain levels. It's not going to be so spiky in your face, right? Yeah, there you go. MG is saying, he says 6E looks a lot like NASDAQ trade some days, which tends to be a little more volatile and spiky, a little bit sort of, you know, how would you say, in your face a little bit. It goes further than he expected to when it retraces. Now, like I said, I mean, if you can handle that and you get good at it, look, you can make good money at these. There's some big moves here. And at 12.50 a tick, of course, you're gaining more than twice as much on an equivalent move to the dollar. In other words, when you get in a move here, you need twice the contracts, more than twice the contracts to equal a move here, right? 6E is going to move times 12.50 a tick. Here you're looking at a move times $5. So in a strict pure dollar point of view, it's risk return. Half the risk, but for the same equivalent type move, you're making half the money. That's the trade-off. Everybody see that? What instruments do you suggest to trade? Chow, what was your question there? Something AM Eastern time? What time are you trading there, Chow? I mean, I can give you some advice in that area. Chow? 4 a.m. Eastern. You can, let's take a look at the instrument list here. And let me answer this in a way that it speaks to everyone who has different time zones. Because I know we literally have people from all over the world in here. And let me do it this way. Let me do it this way. Let me expand the 6E chart out and talk about this so I can speak to different time zones, because not everybody's trading in the U.S. time zone, or a lot of people trade at night because they have jobs or, you know, family or business commitments, or you're retired. So the 16th was Friday. Let me answer that question in this way, Chow. Friday was the 16th. Yeah, 16th right here. So this is midnight Pacific time right here. So in the late evening time from 5 o'clock Pacific up to midnight is what's called the Asian trading session. So Singapore, you know, throughout all parts of Asia, let me put this right in here so we're all clear. Oops. Asian trading session. So now, if you're in a part of the world where this is the session you want to trade, and you're looking for price action on instruments to trade, then you're going to want to be looking at 6A, okay, Aussie dollar futures, or 6J, yen futures. You can also look at gold. And you can look at some of the equities. You can look at the dollar index and some of the equities like ES, but you may not have much movement in there. I would avoid the commodities. There's no volume in huge spreads, so I would avoid the commodities. All right, now when you get past midnight into the early hours of the morning in the US here, through the open at 6:30, now you're looking at the European trading session. Let's talk about instruments you can trade then. There's a whole slew of instruments that you can trade in the European trading session from midnight on. Now here you're looking at 6B British pound, 6C Canadian, 6E the euro, 6S the Swissy, so all these currencies. The yen and the Aussie are going to be slowing down coming out of the European session, 6A. So I'm answering your question, Chow. If you're an early morning trader in the US, you want to be looking at 6B, 6E, 6S, the CAC, dollar index, the DAX, and FGBL, the Bund. Here again, I would avoid, you can look at the gold. Gold may have some movement. Be careful, look at the spreads and the volume. I would avoid the commodities down here. Wheat, corn, and what have you, the bonds, the notes. The bonds and the notes open up at 5:30 Pacific. ZB, ZN, and ZF, right down here. ZN, notes, ZF, $5 futures. Okay. So early morning, you can look at the currencies, basically. Now, if you're going to trade the currencies early, you have to be aware of the news that may affect them, much like we are when we look at, and I'm just going to do this very quickly and get back to the charts. In other words, the European sessions and the Asian sessions also have news that affect the currencies and the movement of those equities, like the CAC 40. So, for instance, on your Forex factory site, you have to make sure that you add those instruments to the ones that you're tracking. And that would be, so for instance, if you're trading 6E or anything, or the Euro cross pair in Forex, or GBP, USD, or 6B, anything related to the currency futures, you want to be aware of the news that can affect those prices, those instruments overnight. A lot of times there is, Chow. That can be frustrating. You know, a long time ago, I owned a Forex company. I was partners in a Forex company, and we had a whole huge, we took a call center in India and trained a floor of traders over there, Forex. And yeah, overnight it can be choppy, right? Early in the morning it can be extremely choppy. Sometimes that's not the time to trade. The exchange for FGBL, it comes through your data feed, Mary. Let's go ahead and pull up some different instruments now that we're talking about them. Let's see, FGBL. Let's pull FGBL up. Chow, that's also, yeah, that's some good questions. You have to also look at your broker for, now that we're talking about different instruments, the other thing that comes into play here is the margin. You have to, you have to look at the margin on your the margin requirements for day trading. Here's FGBL right here. Sometimes overnight these instruments get some decent price action, some good movement. Let me take the predictor off for just a second here. All right, so here's the movement on FGBL. Friday was right here. Here's midnight Pacific time, so translate that into your time zone. Here you had a nice up move right here. Came down, broke the mid-band, came up, rolled over, and you started going a little bit of a downtrend for some shorts. Here you had a little pop up. Here you had a pop down. Here you were in an uptrend. You had a nice sell-off over here. Let's see, this would have been Thursday, midnight Pacific here. European session, Asian session, late in the morning. Let's see, Friday, Thursday, Wednesday. This would have been Tuesday on FGBL. Early in the morning, midnight, you got a little pop up. It looks pretty smooth, doesn't it? Looks pretty smooth. Yeah, this looks like a fairly smooth. I haven't traded FGBL in a long time. I haven't even looked at it, to be honest with you. It's the first time I've looked at it in a long time, but it looks fairly smooth here, doesn't it? I don't see a lot of whippy, spiky kind of moves out of it. How much per tick? You know what, Mary? Truth be told, I haven't traded this in so long. I have to look. Stand by. She's asking what the dollar value is per tick to assess the risk on it. Anybody know that? FGBL, dollar value per tick. Anybody know off the top of your head? I don't know. I have to look it up. Stand by. I'll look that up real quick here. See if I can answer that for you, Mary. FGBL. $10 a tick? I think it is $10 a tick. Here's how you figure that out real quick. Yeah, it's pricey. $1,000 per point, and there's 100 ticks per point. Yeah, so $10. $10 per tick. Yeah, $10. See how you figure that out? Obviously, you find out what your point value is for any instrument. They're all shown right here, right? Here's the point value. and then you look at, so the E-mini S&P, here's a good example, right? So $50 a point, and there's 4 ticks in a point. So that'd be 12.50. That's 10 euros, Peter. You're right. 10 euros. 10 euros. And it comes through your same feed. So if you have CQG, if you have Continuum from Ninja, you know, it all comes through that same feed. Yeah. So what you're going to want to do is pull the instrument you're considering up, and just scroll through the chart, and then look at the times that you want to trade. So if you're a night trader, you know, look at how much movement, how much volatility you have you know, overnight or early in the morning, in case Chow was asking 4 a.m. Eastern. Let's look at a couple more real quick here. 6A. Dollar index is very smooth, Adam. Most days, I can't say every day it's perfect, but we have a lot of traders. We used to trade the dollar index in the live room. It was one of the instruments that we tracked. We had 6E, we had the dollar index, we had some other things. I think we had gold for a while. And you know, the bottom line is you want to find an instrument that speaks to your trading style. All right, you can see 6A has been pretty choppy. Here's the movement on 6A for Friday here, Thursday here. Yeah, Wednesday. Look at this, just in a total range. Wow. Doug, to add the ICE data feed, if you want to get the Russell and what have you, other instruments, I think it's $112, depending on your broker. 112 to 125 an extra per month if you want to trade the Russell and the ICE data feed. Yeah, so you have to contact your broker and set that up. They can take that usually right out of your trading account each month. So you can see 6A last week was pretty choppy. This is the Aussie futures. 6A, Aussie cross pair, basically equivalent in the futures value. Had a little bit of sell-off here early in the week. Looks a little spiky. I don't trade 6A. Let's look at a couple other ones. Anybody in here trade gold? You want to see predictor on here? Okay, sure. Excuse me. The predictor, of course, is going to show the range. You know, when you're in a range, that's the real value add of predictor, is that the swings are going to be bunched tightly close together at the top and bottom of the ranges, like this. See them? So here's predictor, here's without predictor, predictor without predictor. So in the case of this, trading 6A last week, you would pretty much have to trade the range, right? You know, when you got these pops up, you'd have to take your profits when you got very short little scalper trades. And then when you're breaking down, you're taking shorts and you're covering at the bottom of the range. You want to see 6J, Ed? Okay. Japanese yen futures, 6J right here, coming up. Data is loading. Stand by. Dollar is slow at 4 in the morning Eastern. Yeah. 4 in the morning would be 1 o'clock. To be honest with you, Chow, it's kind of hit or miss. It's a little bit hit or miss on the currencies overnight. You know, sometimes if there's some news over there, you know, you get some very nice big runs and you can step in and catch them. Other times it can be very slow and choppy. So you just have to be careful. If it's too slow and choppy, I'd be careful to whether you trade it or not. Okay, here's the yen futures, 6J. A tad on the spiky side, a little bit choppy in my view. Here's midnight Pacific, so going into the Asian session on Friday, you look like this right here. Now, when I say a tad on the spiky, choppy side, here's what I mean, and this is just my personal opinion. So I mean, this isn't anything. You know, you can form your own opinion about the instruments, obviously. But you know, when I see things like this, in other words, here's what I'm saying: is for me personally, when I quickly assess whether I want to trade an instrument or not, when it is starting to go into a trending type move, say down like this here, see how it's kind of trending, starting to trend down a little bit. See, it's trending down, trending down. You're trading the short side. I tend to look, what my trading eye goes to is how it reacts when it gets around the midband. I like if it comes up close to the midband in a trending move for short rollovers. Just for me personally, I like that. I like when it respects it. I think that's nice and clean. You get good trades that way. They roll over, you box it in, you use your tools, and you get short, and then you scalp and you trail your stops. When I see things like this, big huge spikes above the midband when it's trying to trend, that makes it, that's tougher to let's see here, showing my cursor moving. Everybody see my cursor on the chart? Right, cursor moving. Everybody see my, shouldn't be paused, Peter. Cursor is moving to the right. Everybody see this? Cursor moving on the right hand side of the chart. Wasn't before. You see it now? Okay, all right. I may have been paused. Sorry about that. So anyway, back to this. Yeah. So see, this is what I was saying. Is see how from this point here on Friday you had broken down and you were more or less kind of going into a downtrending move where you're trying to take shorts like this, short, 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 short. And by the way, let's do a quick question on that. Let's take this away. In this area right here, were you still in a downtrend? Right here. In this area right here, were you still in a downtrend? Is it a downtrend or a trend change? Right in here. Downtrend or a trend change? Right in here. So is this just a continuation of the downtrend, or are we changing trends here? No, downtrend. Yeah, it's still down, still down. So circling back to our earlier topic, when we say when we're in a protracted trend, in this case down, how do we know? And this is taking from Thursday night, part 1 of the trend change discussion. Generally speaking, if you're staying within the outermost band, okay, that's a quick way to just sort of figure that out. These are called deep probes, deep retracements, whatever you want to call it. In other words, the overall trend is still down, right? You're still putting in a series of, for the most part, lower highs and lower lows. So the trend is down. We're trading the short side of the market. And sometimes the markets come back to the midband or just shy of the midband, and they roll over, giving you short entries, as in here. And over here, we're looking at 6J. This is the Japanese yen on Friday. Hitting the midband, we like that, right? Hits it and rolls. Short, we're short, we're short, we're short. Now, the one couple of trades that we've talked about that some traders might get a little frustrated with is when it goes much beyond the midband to the outermost band and then finally rolls over. And I think visually the challenge to it is that you're seeing some blue bars. It's going a little higher than you expected because you might have expected a roll right here, yes? Right in here. And then it pops up. Sometimes you'll get short from here. You'll get a scalp and then stop out. Chai, that's a good question. So let me be clear about this. As long as we remain under the outermost band in a trend, we are still in that trend. And when I refer to the outermost band, in the case of a downtrend, I'm referring to this band right here, like that. And over here, we're referring to this band right here. You're still in the trend, right there, still short. And I know that's a challenge for some of you. I understand it. Not all of you are going to want to take these deep probes. Visually, it's very challenging to you, and I understand that. But the rule of thumb is as long as you remain inside of that outermost band, you are still in the trend, in this case down. So you're still short in the market. That happens. I was just saying that, there are cases where if you wind up getting short, let's do an example where you might have stopped out here. So for instance here, if you were shorting a box or even a ray or a line tool, at the mid-band retracement, it's quite possible you got in this trade. Maybe you got a scalp, maybe you didn't, and then you would have stopped out. You see what I'm saying here, everybody? Let me open this up. Let's talk about this for a second, because I know this is a challenge for almost all traders. You come up and you use your tools to get short at the mid-band. It gives you a little pop down. Maybe you get a scalp, maybe you don't. And then it comes up and it stops you out. And then the second problem with this, the second issue, is now you have to step back in and re-short it up here after you just got a pop. Isn't that tough to do? Let's be honest with each other here, right? Isn't that tough to do? It happens. How do we make money long-term trading if we're going to get stopped out? We say, well, Charles, what you're telling me is that I'm gonna get some losses. I'm gonna get stopped out on some trades. I'm gonna get a scalp and get stopped out, or maybe I don't get the scalp and I get stopped out. How do you continue to make money long term if you're going to get stopped out? I mean, that's a serious question, right? If you're going to be a long-term trader and make this a living for the next 10, 15 years and retire off the money, how are you going to do it if you're going to get stopped out like this? What can you do to help yourself in cases like we're describing right here? Human capital chipping away, Carl. Mary C says a little tip, wait for a clear lower high, prevents a lot of head fakes. Yeah, that's true. Sometimes this is called a phantom trade. Yes, yeah. If you have a long, protracted, trending type move and you go up to the outermost band, oftentimes that's referred to as a phantom trade, right? Risk reward has to be 2-to-1. Control losses and let the runners run, Lauren. Yes. You have to have more with your winners than your losses, MG, right? More ticks on the win side. You should have a chat room at 4 a.m. Eastern. The expertise of Charles and Gary is required at this time. That's a good one, Chai. I wouldn't, all due respect there, my friend, I wouldn't hold your breath on that one. That's a good suggestion. We'll take it under advisement, okay? All right, so here's the deal. How are you gonna survive the game if you get these stop outs, right? So what it comes down to is this: and I think it was very apropos. 2-to-1, keep the losses small, let the runners run. All right, so what we need to do is when we take the trades that are moving in our favor, we have to maximize the gain from those trades. So for instance, if you stopped out here and you re-entered here, you got to ride this short all the way down as much as you can. Each time you get back into a market when you're trading the short side is you got to maximize the return from it. You got to squeeze every tick you can out of the runners that are running and making you money. And generally speaking, you want those runners on the winners to be at least 2-to-1 over the stop losses. Because it is in that, and plus you want your win ratio to be at least 67 to 80%. Okay? Let me just put that right on here. Now, some of you might not be the best at calculating all these things, math and ratios and all manner of stuff, and that's cool. You just got to remember this simple thing. You want your win rate to be at least 67% to 80% plus, and that is achievable. By the way, most of you say, "Oh, that's insane. I'm never going to get that." It is. A lot of traders do this. I'm talking about for you to be successful as a long-term trader, you have to aspire to have a win rate that is at least 2/3 to 3/4 or higher. Okay? And you want your win to loss ratio to be at least 2-to-1. In other words, the amount of your gains in terms of your trades. Let's just do some numbers. Okay, so let's say on this trade you lost $50. Okay, well, you want the win on the next one to be at least $100. And you should be tracking, you can track these numbers, okay? You can track these numbers. Each day you should go back in and look at the trades you took and see what you did. How much did I lose? Okay, I took two losses and I lost this, whatever, 100 and a quarter. You know, and I took 3 winners, and the 3 winners each made more than $100. So I came away with a 250 win, and I kept my losses fairly small when I got stopped out. And my runners, I let my runners run, and I made good money on those runners. So that's what this means. If you're trading, let me ask you this question. If your win rate is 50% and your win-loss ratio in terms of the winner, the dollar, you know, or tick value of your winners is 1 to 1, are you going to make any money? Okay, here's another trader. Here's trader A, here's trader B. Trader B has a win rate of 50%, and trader B's win-to-loss ratio, this is winners versus losers, is 1 to 1. Is that trader making any money? Trader A is up here. Higher win rate, higher win-to-loss ratio in terms of dollar or tick value. Here's trader B. 50-50. Half the time you win, half the time you lose, and you get stopped out for $50 or $100, and you make $50 or $100. So it's 1 to 1 in terms of your gains and losses. That's right. Trader B tends to be a losing type trader because on the surface you say, well, trader B would at least break even, yes, right? But in reality, no, because you have the cost of commissions. So when you factor in the cost of commissions, trader B is actually losing money. So what we have to do is we have to get our win ratio up, and that is a function of how well you're able to see and take the trades. So that's a matter of practice and chart time. And then we have to let our runners run. It's such a cliched statement, I know. You've heard it probably 1,000 times. Let your runners run. And you choke off your runners all the time, and you let your losers go against you. This is a tendency we have to try to fight and stop. If I'm speaking to anybody here this morning, that's one thing you have to try to really work on. When your runners are running, you got to let them run. Okay, you have to maximize the gain if you're ever going to get to 2 to 1. And your losers, you have to come to accept. You have to embrace those losers. It's going to happen. You're going to get stopped out, and you just have to take the bite and move on. You have to. Because if you're sticking around this 50-50 program and you're choking off your runners and you're letting your losers beat you up, then the commissions are just going to eat you and you're not going to make money long term. All the time, Ed says. Most stop losses on the charts are going to be around 10 to 12 ticks. Now, it's a function of the swing levels usually. You know, if you have it's not, generally speaking, it's going to be 10 to 12 ticks. In some cases, like let's take this trade where we got stopped out. Let's say you get filled short on one of these bars here coming out of the box. Well, your initial stop is going to be sitting probably up here somewhere. Now, this is another thing I was going to suggest that can help you. Sometimes when you get a pop out of the box, like in this trade right here, short, and you get a quick scalper trade, maybe you got a couple of 3-5 ticks out of this, you can take your stop immediately down close to your entry. All right, so maybe you make a couple of ticks, maybe you break even, or maybe you lose just a couple of ticks on the trade. So your stop's up here, 12 ticks. You get a pop down, you get filled, you immediately take that puppy down into here like this. Now when you stop out, you don't take the full 12 tick hit. Because if you don't do that and it comes down and you take the full 12 tick hit, what stinks about that is that now you got to get back in right here where you just got stopped out, and sometimes that's really tough to do. Got to hold the winners, Ed. That's right. So it's also a function of swings, Chow, is, you know, if you had a swing level very close to here, you know, generally speaking, you would put your stop close to it. But if you use Object Trader, it's going to put it automatically at whatever level that is. Yeah, okay. What else? I'm out of time here, but I'll stick around for just a couple more minutes. What other instrument do we want to see? Let's pop one more up here. One more. What on this list? Do you want to see gold? Anybody? Just type in an instrument. What do you want to see? 6B, 6S, gold, ZF. I love ZF, by the way. I really do. I'm really coming to spend a lot of time past few days studying ZF. I'm going to start increasing my exposure to ZF. Oops. Yes, we don't want that one. Let's try gold. Hold on. Stand by. Give me a second, please. Mary, I'll try to answer your question there. Mary's question was, how do we work to stay in a trade when it starts pulling back against you? You got to use your trail stops. Got to use those trail stops. And trail stops levels vary per instrument. Let me see if I can get gold up here. Stand by. 1 second, please. You know, next week we could. Question about can we have a session on trading gold? You know, but by the way, let's take a quick poll before we run out of time. Does everybody like what I'm doing here, looking at other instruments? Should we do this again? I can do this again next week if you like looking at other instruments other than what we have in the room. I mean, I could definitely do that next week if you want to. Yes, please do. Okay, love it. All right. Okay, let's mix it up. Next week I'll make the topic looking at other instruments. Absolutely. Look at a bunch of other instruments. Okay, all right, let's do this again next week. Okay, here's gold. Now you can see that everybody, let me stand by. Everybody see my cursor moving right here? Cursor moving, circling, gold chart. Gold charts, cursor moving. Make sure I'm not paused. I really like the risk discussion too. Okay, Thomas. You know, if you want, everybody, I'll continue to drive that point home. I have to say that in all my years of doing this, that's the one topic most people don't like to talk about is risk management, losses, and controlling your losses. Win ratios, percentages, stop losses for the day. These are all topics most people just don't want to talk about. We got to pound it into the head. That's right, Mary. This is very important. In terms of long-term trading success, risk management is probably the most critical. No question about it. Yeah, if you aren't managing the money properly and you're taking more hits and your win ratio is not good, all due respect, it's going to be a tough time trying to make it long term. Or you're going to wind up being one of these traders like I was and other traders for a while when you first get started, where you blow up an account, right? You go save some money, you get your grub stake back together, you go start trading again. What do? Blow the account up, right? Go save, come back, get a little money back together, trade, blow it up. Trust me, I know that cycle. For a few years, I went through that cycle. I know it was probably as good or better than anybody. Trust me. So in this case here, gold was pretty tough in the fact that the trend was generally down in the case of Friday, late Thursday going into Friday. Gold was trending down, but you had to be pretty good at taking deep probes into the outermost band. See how you get these huge spikes up? Gold can do this some days. Okay, everybody says, oh, you make a ton of money trading gold. Well, you know, I beg to differ. There's some days where it's very spiky, very choppy, very sideways. You know, you're getting in. So we're talking about head fakes at the midband, right? So here's a head fake at the midband, rolled, spike in your face. Here's another one. Roll, spike in your face. Roll, spike in your face. All right. Gold is not the panacea that everybody thinks it is. Oh, you can make a ton of money trading gold. But sometimes you can, okay? If it's trending very nicely and behaving itself, sure. If it's very spiky and whippy, it's just going to be the same as any other instrument that's spiking in your face, right? If you're a deep probe trader and you don't mind trading these deep probes like this and you're good at that, yeah, of course, you'd be cleaning up here. You'd be nailing every one of these things. See them? Boom, 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 all the way down. If this isn't your style, and you're more of a mid-band trader where you like those rolls, then you could have been spiked out a couple of times. Yeah, I'll put predictor up. Yeah, just showing swings. Yeah, Carl, that's true. Everybody talks about the big fish, but they don't talk about all the ones that they lost. You know, I have several friends that like to gamble. They go up to Reno, they go to Vegas all the time. They always come back with the big checks and the trophies. Well, look, I hit this. They hit the slots. Look at this huge check. I came back. I made 6,900 on this one day. Well, they don't talk about the 10 grand they put in to get there, right? Nobody talks about that. Anyway, okay, all right. Well, let's go ahead and wrap it up.